The problem is once these loan companies receive notice that the company needs to enter into an insolvency process, they then start legal proceedings against the directors, and that affects you and your family with all of your assets, including your home. I see a lot of company directors now who, before they come to me for advice, they've gone out and they've sought this type of unsecured loan. And unfortunately, when they come to us, it puts them in a totally different position than they were beforehand. I've been advising directors for over 30 years, and ordinarily a director would approach me and he'd have HMRC debt, he'd have trade creditors, he'd have maybe a bank overdraft. And there'd be ways in which we could deal with that. We could restructure that for them and help give them advice, which could include an insolvency process, but in a lot of cases it wouldn't. And the directors could either come out of the situation repaying the liabilities, or if necessary enter an insolvency process and get to fight another day. Unfortunately now, when directors have obtained unsecured loans that they've personally guaranteed, it means that the position's completely changed, because when they approach us, they have to look at what it means to them individually. So why are you applying for the loan? What's it for? Most people we see are applying for it for something like a VAT liability or some form of HMRC liability to repay. It's a short-term cash flow issue. In most cases, the amount of money that a director can obtain is not enough to pay off the liabilities of the company. And because of that, it's just a short-term fix. It's a plaster over a gaping wound. In my opinion, I think a director should seek advice before obtaining a loan like that, because in most cases, there are other issues afoot with the company that need looking at prior to just throwing more money at it. If your company's got a short-term cash flow problem, there may be other ways to resolve the problem as opposed to just borrowing more money. Because in a lot of cases, we see directors of businesses, they obtain money, but it's never enough. It's not enough money to pay off the liabilities of the company. And therefore, all they're doing is kicking the can further down the road, and at some point, they have difficulties as a result of it. But these difficulties are worse because they've now got a huge chunk of a liability that they have personally guaranteed. So the limited liability protection is not there for them and their family. The main question is it sufficient to plug the cash flow gap? Is it affordable? Can your business repay this loan? Or will you be required to repay it as an individual? If a bank refuses to give you a business loan, there's normally a reason. If you obtain a loan from one of these unsecured lenders, the chances are they're giving you the loan personally because you've got personal assets that can guarantee that loan. So the term unsecured loan really gets me. I don't understand why it's called an unsecured loan, because it's usually personally guaranteed. And in my opinion, that's the most secured a loan can actually be. Because if it fails, everything is on the line. All your personal assets, which can include your house, if you've got any other shares in limited companies, those shares in those companies can be pursued. Your car, any actual asset that you own as an individual can be pursued by the loan company. So in some cases, a business loan is the answer. If your business is viable, it has just got a short-term cash flow problem, and you've worked out the figures to show that it can repay that loan, well then it's always better to obtain a loan like that rather than the company going to an insolvency process. The problem with these type of business loans is, from our experience, the amount that the director can obtain is not enough to deal with the problems that the business is encountering. I mean, the reality is, it's very rare that directors are under that sort of level of pressure, time pressure. There are always things that you can do to prevent action, even if it's via creditors. The problem is directors, it's not their day job to understand the Insolvency Act and the options that are available to them. So therefore, If they approach us, we talk to them about what we can do to give them that time. Just making a decision to obtain a loan without doing this process first because you're under pressure and you think that you've only got a short period of time is usually the reason why directors end up failing and having problems with their own personal assets as a result of it. They start their proceedings a lot quicker than high street banks. Usually within a month you'll receive a stat demand and then potentially a bankruptcy petition, which obviously then could include them realising any equity that you've got in your residential property. They could go down the route of a county court judgment and obtaining a charging order against your property. I think it's pointless getting an unsecured loan that's not enough to pay off any liabilities that your company has, because all it will do is ease your cash flow for a period of time, and then eventually the loan repayments are so high that it puts you in all types of difficulty. So it can end up putting your business in a worse financial position long term. Well, the worst scenario I've seen was a couple who were based in Derby. They had a limited company. They owed HMRC close to £1 million. Rather than seek advice, they sought loans that they secured against their property for over £500,000. They received the monies and they paid HMRC the £500,000. HMRC said thank you, and then within a week they wrote to them for the balance of the monies that they were owed, which was approximately another £400,000. The company was unable to repay it. The company then went into liquidation. The directors had secured loans against their property that was personally mortgage free, and they still lost their limited company. But if your limited company's gone into a process, how do you fund your repayments on a mortgage if that's the way you take your remuneration? The first thing I'd suggest is that we do a review of the business. We assess if there are any threats to the business, if any creditor action is looming, how do we deal with that to protect you whilst you assess what your options are. Do not make any knee-jerk reactions by obtaining more loans to pay off liabilities until you know exactly what that will mean to the business and to you as a director. Before taking out any loan, I would ask myself as a director, is the business viable? Can the business afford the loan repayments? Are you aware of your liability personally if the business can't repay the loan? The reality is everything's confidential. Nobody finds out that you've spoken to AMS about your business. We come up with a solution for you. We don't charge for that. And the reason we don't charge is that we provide a service to you as a director and give you your options. Some of those options will include a process where we would charge and we'd have to inform you what our costs would be for that process. But I would say in probably 8 out of 10 directors that I advise, they don't need an insolvency process. There's a way of informally dealing with the problems that you've got. There's ways of dealing with HMRC with regards to obtaining realistic time to pay agreements. You do not always need to borrow more money to pay off a creditor when your business could probably pay it off over a period of time, and providing that a professional advisor can vouch for the figures that you've provided to these creditors, there's a very good chance that they'll accept it. If you email me on my email address, we can arrange a Teams call in which you'll speak with me and we'll talk through the problems that your business is facing. And if an unsecured loan is a way forward, I'll tell you that's the best thing to do. If it's not, I'll give you other options and you can decide.